Hello everyone, Stephen Morris here with Advisory. Today we're going to talk about a concept that is near and dear to the syndicator's heart, and that is around the concept of phantom income and what phantom income has in terms of tax implications for your investors. Let's dive into it and how this looks. So imagine it's around April and your investor opens up his inbox and sees a K-1 coming from your tax preparer. And the K-1 under box 2 for rental real estate says $10,000 of income. And the investor's thinking, well, that's interesting because I never received a $10,000 check, so where's the income? Well, what ends up happening is that income carries forward into the investor's tax return, and they're going to pay taxes based on their marginal tax rate. Let's assume 37% of $10,000. That would work out to be federal income tax of $3,700. Now, in this extreme example, I really hope they financially plan for this. They might be thinking, I don't have $3,700 to pay in taxes. Where is this money going to come from? And furthermore, how did we report $10,000 when I received no distributions? What's the main problem? Generally speaking, this type of phantom income comes from the fact that the property cash flows were only sufficient enough to cover debt service. And why is this important to consider? Because principal payments on debt service are not deductible. And because they're not deductible, the amount of income is not translated to actual cash put into the investor's bank account. Because actually the investor is realizing income if you think about it. They're gaining equity in the property by paying down the loan. However, they're not looking at it that way, generally speaking, because they're either not sophisticated enough or they just don't care. They just want money. They don't care how it comes. They're not interested in the reasons why. All they want to make sure is that at least their tax bill's covered. And so you, as a syndicator, are going to have to plan for this outcome through the concept of a tax distribution. So how does this work? At some point down the road, you're going to have to plan for this outcome by setting aside cash on your balance sheet for this particular day. This day will come usually as a good result of all your planning. What that means is the property is done well, the rents have increased, your costs have stayed flat, you've already used up all your depreciation, and now economically speaking, you're really starting to hum along here. And at this point, you've got to consider setting aside cash to distribute to the investors so that they can actually pay their tax bill when it comes to tax time. To plan for this eventual outcome, my recommendation is that in the early years, if cash flow from operations, for example, is $5,000 a month, that you don't distribute all $5,000 to the investors if you can avoid it. My recommendation is to maybe distribute $4,000, for example. I don't know if that's the right number, just stating what the facts could be. Hold back the $1,000 in cash and stick it into an interest-bearing savings account, okay? At some point down the road, if you have a wobble sort of, or a difference between cash flow from operations and taxable income, you have the money set aside to pay the investors for their tax outcome. Why is this important? Because typically speaking, investors don't remember what happened in previous years. They like to forget. It's very convenient. Hey, I didn't plan for this. Well, I gave you so much money in the early years. Why didn't you set aside some from the early years when I paid you? It's not my problem. That's your problem. You should have planned for this. And everything becomes your issue, right? Now, that's another discussion altogether. You may consider never bringing back those investors into another deal. But for the time being, you're stuck with them. I mean, they're in your deal. You still got to report to them. They still have legal rights and legal obligations. And you know what? They'll blow up your phone anyway, and they're going to bother you. And at some point, you're going to think, you know what? I would love to just pay this guy off to leave. You don't want to get to that point. You do want to plan for that particular outcome. And that's why I highly recommend that you have a cash flow forecast. You start to understand, hey, I can't distribute all of the cash out of the property as soon as possible. I got to hold back some for this eventual mismatch. And if you plan for all these things, then I think you'll have a fantastic tax outcome. Investors will be generally very happy. And more importantly, you want them happy so they can invest in your next deal, which of course is the name of the game here as a syndicator. So I hope this helps out. It's a little tax tip here on the mismatch between taxable income and distributions. But if you find this helpful, or if you'd like some guidance or advice on how to get around this particular issue, then feel free to contact us right here, and we'll be more than happy to assist you. Thanks so much for watching. So make sure to like and subscribe to our channel for all the content related to real estate investment and tax saving strategies.